Hey everyone, in today's video, we're going to go over my $185,000 stock portfolio. It's been a while since I've done a portfolio update, so I'm hoping that you guys get a lot out of this. For those of you who haven't seen any of my content before, hoping you get a good sense on the type of stocks I like to buy, my purpose behind investing, and what I really look for in stocks, how I approach the market, so on and so forth. If you like this type of content, be sure to hit the thumbs up button. Also, would love if you subscribe to the channel. And if you have any thoughts on any of these stocks or any other stocks that you're interested in or you may hold, would love for you to drop it in the comments. Okay, getting into this video here today. So my total portfolio in my Wealthsimple brokerage account is about $185,000. $135,000 of that is in Canadian dollars. The remainder is in US dollars. Going into my Canadian portfolio first, and as a disclaimer, those of you who don't care about my Canadian stocks, just want to wait for the US stocks, I'll leave a timestamp below so you can skip this part if you so choose. So in my Canadian portfolio, I'll start with overall. I'm up about 8%. In the last year, only up about 2%. And this portfolio, I got about, I believe it was like September, October of 2020. So pretty happy that this portfolio is up despite the market kind of going down since then. And I think it's really based off the type of stocks I buy are more consistent, less volatile, which you'll see in a couple minutes here. But with that being said, I do have some big swings that are worth noting. The first stock that I own that I want to go into a bit is Allied Properties. So Allied Properties is a Canadian real estate investment trust. This company is one of my worst performing stocks over the last number of years. So the company is down about 50%. This company has consistently done about $2.20 of funds from operations from real estate activity. And it just used to trade at like a 20 to 25 times multiple, currently trading at a 10 times multiple. So the operations remain the same in terms of the funds from operation that they're deriving, but the multiple that is being charged has gone down significantly. And this is mostly because of their core asset class being office real estate and just concerns on the future of office real estate. And in addition to that, obviously playing in the REIT space, they're very susceptible to interest rate increases. So it's kind of a lot of negative sentiment around both the macroeconomic in terms of what the interest rate environment is going to be like, as well as just the office space segment of real estate in all. And that's really leading to this company to being 50% off. That's giving it a 7.6% dividend yield. And on a funds from operations standpoint, this company's trading at under 11 times when it's historically been closer to 25 times. So my overall thoughts on this business is I understand why increase in interest rate would have a dip in the stock. I understand why office exposure may be trading at a bit of a lower multiple than before, but I think a 50% drop versus net asset value and versus historical is a bit overdone, especially when you look at the assets that this company owns. It's really prime flagship downtown office space in huge cities across Canada like Toronto, Montreal, Vancouver, etc. So I acknowledge that this company may not be worth the same price it was, up here in the 50s, but I think in the low 20s is way too cheap for the assets of the underlying company. I think they can sell off the company in pieces and make double what the current share price is trading for. So this is one that I don't really need to be a big position given the space that it's in, but I do think it's undervalued, and I will be, nibbling in 5 shares here, 5 shares there. In terms of my position in Wealthsimple, I have about $4,000 of current value, down about 20% in the position currently. I won't go over every stock in that much depth, but A&W Royalty is a royalty fund, pays top-line royalties on the A&W restaurant brand across Canada. This is one that's just pretty safe company in my opinion. I get a nice monthly dividend. The yield right now is paying at about 5%, down 7% over the past year. But these companies are pretty inflation resistant. Lots of people trade down into fast food during inflationary times and recessionary times. And A&W, as their input costs go up for their franchisees, they increase the price and you're getting a percentage over a higher bill size essentially. So inflation kind of gets priced in organically on this kind of company. I have a couple other royalty funds that you'll see coming up, but I just really like those business models as being a nice cash flowing part of my portfolio. The next stock here is Bank of Nova Scotia. So Bank of Nova Scotia is a Canadian bank. I think it's currently trading between 8 and 9 times earnings. They operate in Canada, but also have a pretty big Latin America division, which, with some uncertainties and variabilities in that market, has really hampered the performance of the overall company. The company's down over 20% over the last year, and overall, I'm about flat on it. I've been slowly nibbling in. It's not a big position for me overall. But this pays over a 6% dividend yield, is trading at 9 times trailing earnings, and has increased their dividend every year for decades on end. So definitely an attractive entry price from a yield on cost standpoint, as long as they continue to do what they've been doing over the last 10, 20 years. Moving on, Canadian Apartment REIT. So very similar to Allied Properties, just less of a dramatic story. Given this is residential real estate, they don't really have the demand destruction that people are anticipating from Allied Properties, but they do have the headwind of interest rates going up. So in this one, I'm only down 10%. I get about a 3% dividend, I believe, 3.1% dividend here. In my current portfolio, down about $500 in this account specifically. Over the last 5 years, you can kind of see the volatility here really skyrocketed as interest rates went down up to $60, now down to the mid 40s. And I've kind of been averaging it on the way down there, which is why I'm only down 10%. This is an interesting holding. I hold $15,000 of just straight cash. So this ETF is just a high interest savings account essentially, and it pays me 5% annually. So about $750 a year. I'm getting paid over $50, over $60, I think, a month just to hold $15,000 of cash here. If we look at just how this company operates or how this ETF operates throughout the month, you're kind of getting the value of what the cash payout's going to be, and then as soon as the dividend hits, it goes back to the cash price of $50. That is the money that it is holding per share. So interesting company for those of you who may be holding on to excess cash, tons of money in a checking account or something. This may be an opportunity you may want to look into to monetize that cash a bit more than the 0.1% or whatever your bank may be giving you. CN Rail. CN Rail is probably my favorite stock in my entire portfolio. Across all my accounts, it's my biggest or one of my biggest holdings. In this account, it's still a decent size, $11,000. I'm up about 11% on it. And this stock really hasn't dipped to a great degree over the last number of years. It's been trending upwards, currently at over $160, about 5-6% off its all-time high, I believe. So just great business, huge moat, continues to price over inflation. I think this one's great for the long term in terms of their capital allocation. They buy back shares, they increase the dividend, their balance sheet's in a good spot. So love this company. We'll continue to nibble into it probably over the rest of my life, or at least the rest of my working life. Canadian Utilities. This is a utility company that operates not just in Canada. They have some Caribbean assets and assets from other areas of the world. They have increased their dividend for, I believe, around 50 straight years. But as a bit of a warning, they do have a high starting yield, about 4.6%. So the dividend growth has really been just 1% here, 1% there, like a penny a year. So you're not getting significant dividend increases in this one, but you are getting some, which is nice to at least get a little raise every year on top of the nice starting yield that you're getting. Moving on here, Diversified Royalty Corporation. This one, I have a pretty decent position in this account, over $6,000. Similar to A&W, this company just pays top-line royalties on the trademarks that they own. The biggest one being Mr. Lube. So the car service company across Canada. They also have the trademark for Oxford Learning Center, Sutton Realty Group, and a handful of other smaller businesses. So every month as those companies get revenue, they write a check to Diversified Royalty Corp, who owns the trademarks, and then you get that in form of a dividend. So The dividend's pretty high on this one, currently paying about 7.5%, as you can see right here. Overall, pretty small company at $400 million Canadian. So a bit of a watch out there if you don't like to have too many small companies, but I love the monthly cash flow that I've been getting from this one. First Capital Real Estate Investment Trust. This company is a premium retail REIT primarily that, similar to some of the other REITs, have been trading well under their net asset value. This one's paying about a 4.3% dividend. I'm essentially flat on it, down 1%. But I think that the value of some of these REITs with time and as interest rates go down will go up significantly. So that's one that I'm holding on to. I like the assets that they own, and they're doing a lot of things internally right now to crystallize shareholder value. So looking forward to sticking along on that journey. Fortis, which is more of a regulated utility company, has been doing really well for me too, up about 10%, currently trading at $60 a share. To power through a couple more of these here, HDIF and HUDL are covered call ETFs. HDIF is a combination of a bunch of different covered call ETFs, so it's pretty broad market diversification. 25% leverage too to increase the covered calls, which maximizes the income. But with that being said, it minimizes the upside even more. So on this one, it pays over a 10% yield. I'm down 2% on it so far, but I've been getting some nice dividends from this holding. HUDL is a equal weight global utilities income ETF. So in this stock, think about having covered calls on pipelines, telecommunication assets, things like that around the world, not just in North America, and it pays out a 7.6% yield. So also really like this stock as well, has been pretty safe for me, actually up 4% almost, and I've just been collecting over a 7% yield that gets paid out monthly. So on those ones, I've been actually decently happy with. KEG Royalty Income Fund, exact same thesis as A&W. You're just getting a royalty on top-line sales of the KEG steakhouse and bar restaurants. The one, I guess, downside is this business model is a bit less defensive and recession-proof than a quick service restaurant like A&W. So this may have some volatility with the broader economy. Continuing to go down, Life is another covered call ETF that I hold in the global healthcare space. So think about companies like Pfizer, AbbVie, etc. Those are the kind of companies that are held within this ETF. I'm about flat on it, which once again, I'm getting an 8.5% dividend yield on this covered call ETF. So that's kind of my total return there, which I'm overall happy with. And that's really the strategy with these covered call ETFs, just having a portion of the portfolio that's paying me really strong monthly income for me to reinvest in other areas and fuel growth of dividends in other ways, whether that's taking all the money I'm getting from covered calls and buying dividend growth stocks or buying REITs or whatever it may be. It's just part of my equation of how to maximize dividend income over time. Northwest Healthcare Properties is a REIT that's just gotten clobbered. I started listening to their earnings call from a couple weeks ago. It looks like they think they're going to do about 80 cents in earnings per share next year, which would get them to about 10 times earnings here. So that doesn't seem too bad, but the stock's been getting hammered. They have lots of long-term hospital leases with governments, leases with governments that are inflation adjusted, so that should help them a bit. But they're in a lot of different types of businesses, from management of hospitals and medical centers to joint ventures to owning properties outright. So a bit confusing to read their reports. Overall, I think they probably have upside from here, and they're paying out about a 10-11% dividend at current rates. Restaurant Brands International is a stock that I'm up pretty big on, almost 20%. This stock owns the Tim Hortons brand, the Burger King brand, as well as Popeyes. They also acquired Firehouse Subs. So they own a lot of quick service restaurants, hence their stock ticker of QSR. And over the last year, the stock's up 20% with the broader market down. So this company's performed really well. Not really buying more of this stock, but fine to hold what I have. No plans on selling. I'm getting over a 3% dividend yield on it, and the capital appreciation's been pretty strong. So looking forward for some of their strategies to play out longer term. Rogers Communication has gone up as of late behind the finalization of their Shaw acquisition. You can see here over the last month, the stock's up 8%, about $5 a share. My overall position is up 12%, about $600. Still getting about a 3% dividend yield on this. But the future of this stock is just how well they can incorporate Shaw into their business model, how many synergies they can derive from that acquisition, and what the next chapter of growth looks like for Rogers and Shaw combined. So I'm holding my position. I have 84 shares here. I think I have about 300 or 350 shares total across my portfolio. And I think that's where I want to keep this position until I really see things with Shaw unfold. Moving on to Ryokan. Ryokan I'm up about 8% on. This is a REIT that is primarily in retail space but has been growing their residential rental business. Still only, I think, about 4 or 5% of total funds from operations. Also, their office exposure has gone up, which is a good thing for diversification, but not really an exciting place to be right now, as we covered off the bat with Allied. But I think they're really well managed and really well positioned and focused on growth. So this is one of my biggest portfolios across my accounts. In this portfolio specifically, I have $5,000 in it, up 7.5%, paying about a 5% dividend. I think they're making about $1.70 a share in funds from operation. So we're talking about like close to a 13 times funds from operation multiple. I think that's not dirt cheap, but probably in a fair realm for that company given the assets that it holds. TD Bank, I started adding to in this portfolio. I also hold it in other portfolios. Down 4% behind some of the things that have been happening over the last couple months. Down 9% past 3 months, driven by that banking run in the U.S. They have exposure to the U.S. banking segment in general with organic operations, but they also have a stake in Charles Schwab, which has been getting hit based off how they're managing their books, and then also a deal for $13 billion to buy First Horizon Bank, which was one of the banks that regional player in the U.S. that really got hit over the last couple months. You can kind of see this company is a $150 billion company. So even their $13 billion acquisition, if it holds through at that price, First Horizon is only worth 10% or less of the overall business. I think even if there is risk on those deposits in terms of outflows, them coming into TD Bank should kind of alleviate that risk. People should feel more safe. And even if they don't, I don't think they're going to sink TD Bank as a whole, given just the size and strength of the overall company here being one of the biggest banks in the world. This is probably my favorite bank stock. Pays a 4.5% dividend. I think it's going to do about $9 in EPS next year, so trading under 9 times earnings. This is one that I wouldn't mind adding more to in the coming weeks and months. And then some of my ETFs on the Canadian side of my portfolio. ZDI is an international dividend ETF. I get a monthly dividend payment. I think at current prices, it's probably paying a low 4% yield. And this company owns blue chip dividend stocks across Europe, Australia, Japan, and some other countries. So within Europe, I think it's like UK, Germany, etc. So pretty developed markets and developed companies within those markets, but gets me some exposure outside of North America, which is where my portfolio predominantly lies. ZWB is another covered call ETF. This one on the Canadian financial sector pays about a 7.5% dividend. Unfortunately, given the dip in bank stocks that we just talked on TD, this one has had some capital depreciation, down 10%. So I've held this stock for probably close to a year, and I'm probably net down 3 or 4% in terms of total return, hoping that Canadian banks bounce back, this capital loss or unrealized loss goes away, and I'm just continuing to get that 7.5% monthly yield. The second covered call ETF here is ZWC. That's a BMO Canadian high dividend covered call ETF. So this company owns companies, or this ETF owns companies like Bell, Pembina, Enbridge, probably some of the REITs as well, and they buy covered call ETFs on it. But it's more diversified, high income play across Canadian economic sectors. This stock pays a very similar dividend, currently at 7%, down not as much as the big banks at least. So that's a bit of a good sign and shows some of that diversification within the covered call ETFs paying off. So that's my overall Canadian portfolio. Just to summarize before going to the US one, in terms of the big gains, you can see CN Rail there up $1,200, Canadian Utilities up $600, Fortis up $800. Going down a bit more, you have QSR up $1,600, Rogers up $500, but you're also seeing lots of losses here. So when you add all this up, I don't think it's worth $10,000. The reason being, this is primarily a dividend growth account and a dividend income account. So lots of these gains are actually from getting monthly payments of dividends and quarterly dividend payments that are just fueling the cash position for me to buy more and more shares within my portfolio. So you'll see that to be a common theme in lots of the videos and lots of the stocks I talk about. Lots of my total shareholder return comes from dividends. And there's a lot of reasons why I prefer that means of capital return versus like investing in the business to a significant degree. Like obviously I don't mind companies investing for growth, but I think it's prudent to be returning some of that capital to shareholders through dividends and share buybacks, just to make sure that the company's only investing in the best opportunities they have internally. They're not flushed with excess money. The one example I like to use is with Meta. Didn't pay a dividend, hoarding tons of money, hundreds of billions of dollars or dozens of billions of dollars, and then eventually don't know what to do with it, end up burning tens of billions of dollars doing something not associated with what investors invested in the company for. I'd rather have that money in a dividend. The second thing is I think it puts more good pressure on a company to be more tactical with their capital allocation versus just having them flushed with cash flow on the balance sheet. That kind of takes the pressure off. They can invest in whatever they want. If it doesn't pan out, it's not a big deal. By returning the majority of capital to shareholders, they really have to be prudent and diligent in the investment decisions they make, and they have to make sure they work out. Okay, enough of my spiel. Going over to my US portfolio, I'm up about 16% in this portfolio. It's a $37,000 US dollar portfolio here. If we look over the last year, that's essentially where all my growths come from, up 15% in the last year. And actually in the last 3 months, I have 17%. So 3 months ago, I was actually down in this account, it looks like, and now I'm up by over $5,000. So some pretty big moves there. Going through this account, Google is a $3,500 position. I'm about flat on it, up $60. Coca-Cola, I'll talk Coca-Cola in two parts because I did buy my first put option I've ever bought on the Coca-Cola company. So Coca-Cola is a position I've been building up, just started buying it a few weeks ago, got up to about $4,000. The stock just kept going up behind no news. So I was buying it in $58. It kept going up and up and up about 7-8% from my first buy price. My weighted return now is up about 5% because I was averaging up and up and up. And I decided, like, I really want to build this into at least a 100 share position, $6,000 or so. But it keeps going up, and I feel like it's going to go down. Now, I'm not a very good trader, and you'll realize that here, because what I decided to do is buy a put option for May 19th to give myself the option to sell 100 shares at $62.50. And the rationale was if the stock dips below $62.50 and at least $1.50 below, because that's what I bought these options for. So if the stock dips below $61, then I'll get the opportunity to sell the shares for more than they're worth. And I thought, given how fast the stock went up behind nothing, that may be a good opportunity. Since then, my option's down about 25%. I still have a month for the stock to go down, and it's not up by that much necessarily, but this is one that I'm just going to wait and see how it plays out. Hopefully I get a big sudden drop. I can sell my put option, make some money, take that money, start averaging back into Coca-Cola equity to get closer to 100 shares. But this is definitely not something that I'm skilled at by any means or that I typically do. I just thought it would be fun to test it out. So we'll see how that whole thing goes. Coca-Cola in general is, like I said, a new position, pays about a 3% dividend yield. At least it did. Now it's down to 2.8 because of the stock price going up. But just a really solid company to own for the long term, in my opinion. It's a pretty fully priced asset, but I think they've shown the ability to compound yield on cost and earnings per share over the long term, and that's really what I'm holding it for. Similar story to all my consumer staple companies. McDonald's, $285, going to make about $10 per share this year. So I'm paying almost 30 times earnings for this stock. I'm up about 24% on it overall. Not a big position in this account, only a couple $1,000 given the valuation. A stock that I like to hold, like to have, like to get the dividends from, but definitely see how it's fully valued. Meta, I'm up over 100% in this account. I hold it in other accounts too, so please don't congratulate me on this one. I'm probably not doing great overall, given how long I've held the company. I think Meta's core business is worth so much more than this. If Zuckerberg came out and announced that they are burning Reality Labs to the ground, I think the stock would go up 20% in a day. And I just think there's a lot of untapped potential in that company, and I hope long term that they do the right thing for the owners of the company in monetizing it and getting the right value realized for the company, which isn't being done today. Microsoft is a stock that I really like. I've been buying more of it relatively recently. I've stopped as it's ran up an extra 20%. Can't see where I bought it last, but I'm up 15% on average. My average share price is about $246 here. I get a very small dividend of 1%, trading about 31 times trailing earnings, 27 times future earnings. Up to, like I said, 20% in the last 3 months. In the last year, it's about flat. So company has been moving all over with big tech, but overall with their, gaming business, their cloud business, their Microsoft Suite business, their investments and what they're doing with AI, I think this is a great business to own. And if anything, I'll probably try to add a share here and there of Microsoft, even though it's really run up as of late. Realty Income. So this is the only U.S. REIT that I own currently, just given how much REIT exposure I have on the Canadian side. But I just really like their diversification across the U.S. They also have assets in Europe, in the U.K., Italy, Spain. And I love their strong history of dividend payments and dividend increases. So this is my newest portfolio and my newest holding in my entire portfolio. Bear with me, guys. It's a long video. And I currently have 30 shares, down about 1%, but not too concerned. This is one that I'll continue averaging into over time. First stop will be to get it to at least 100 shares and then go from there. Currently paying just south of a 5% dividend yield. Its fund from operation multiple is about 15 times. So, about 10 to 20% more expensive than my Canadian REITs of high quality that I own, trading at like 12, 13 times. But I just wanted to get some U.S. diversification on my REIT holdings. So we'll see how it plays out and how the multiples compare over time. But I'm excited to average into this one a bit more. P&G, same story as McDonald's and Coca-Cola, in my opinion. These stocks are at the peak value or very well valued. So in case or unless they increase EPS further from here, I don't really think there is much room for multiple expansion given where these stocks are trading. So it will be interesting to watch, but not actively buying a ton more of these types of companies. AT&T is supposed to do about $2.50 of share this fiscal year. So they're trading at about 8 times earnings by my math. I've been nibbling onto more once they dipped under $19. Currently, I have 205 shares in this account, down 5%. But I do like the 7% starting yield that I'm getting on this business. So they have a lot of debt to pay down, a lot of mergers and acquisitions and divestitures that have occurred. So this share price may not be completely fair given how they've split some assets off of the business. But just one that not overly in love with the business, but just think it's undervalued at large. And then lastly, one of my favorite companies that I'm waiting to go down a bit so I can buy this more aggressively. But Visa is one of my favorite companies for 2023. I think the company can trade higher than it is right now. I think right now it's probably trading at a future price to earnings in the high 20s. Historically, this company traded almost for a mid 30s PE. So I just love their business model. It's essentially a royalty on the global economy, a royalty and a bet on uh, cash converting into cards globally and in emerging markets. I think they have a ton of runway, a ton of share to grow, a ton of use cases to address, like people paying their rent through Visa, debit cards, and stuff like that, that aren't being, that this network isn't being used for today. And I think they have a ton of upside on their overall business that will make their current price to earnings in the high 20s look cheap a decade from now. If we just look at their history here, over the last 5 years, the stock's up 90%. Over the last 10 to 20 years, the stock has just exploded. And they pay a dividend, but it's under 1%. So it's not a very big one. They are increasing at double digits every year, though, which is at least nice to see that they're giving you a bit of a compounding yield on cost over time. This company has bought back almost 50% of their outstanding shares over the last 10, 11 years, though. So that's really where they focus on returning value to shareholders primarily. Okay, so there you have it, guys. That is my entire Wealthsimple portfolio. If you like this type of content, be sure to hit the like button, subscribe to the channel. If you have any thoughts on any of these companies or kind of how I talk about dividend investments, how I'm crafting my portfolio, would love to hear from you guys in the comments. If you just want to say hello or thank me for doing the video too, would love to meet you guys in the comments as well. Not too many people make it to the end of these videos, so I really do appreciate all your time in watching this, and I hope to see you guys in the next one.